Fed Chair Jerome Powell just dropped a bomb on Trump's economy. This is what it looks like when someone knows things and is able to translate the knowledge into speech. I know that it's a sort of basic human function, but there's a lot of people in this administration who can't do it. Powell, of course, is not in the administration. The Fed chair is independent. And here he explains what is the effect of these tariffs.
Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation.
Uh-oh.
A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent.
Oh boy.
And that is a risk to be assessed and managed.
Jerome Powell is saying things that Donald Trump is not going to like. He explained with regard to the cracks in the job market. Why is the job market getting shaky? Here he is explaining.
What is your explanation for why the job market is weakening right now? And what will this rate cut do to improve the job market?
So I think there are two things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's two things. That's declining labor force participation, which is a cyclical thing, and then there's declining immigration, which is just a big policy change that actually began in the last administration and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and the unemployment rate has gone down, meaning that demand for workers has gone down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand, and I would just say when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to zero. So maximum employment doesn't, on a sustainable basis, if you're creating zero jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last two meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. So it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools, but others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
What seems clear, and what Powell also mentioned during his remarks, is you should not assume that there is another rate cut coming. Trump got a couple of rate cuts, which he's been demanding. It's funny because you really only demand rate cuts if the economy is struggling. Trump claims the economy is better than ever, and he's desperately demanding rate cuts. But one of the interesting things that Powell said is that in the near term, he thinks there's a risk of inflation going up and employment going down. And that is not a great combination for the economy.
In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals.
This is a situation that could become stagflation. And if that happens, who do you think Donald Trump is going to blame? And who do you think workers are going to blame? So the big picture, as is often the case with the economy, and you don't need to play politics with this stuff. Some of what we are seeing has nothing to do with presidents one way or the other. There are global business cycles. There is seasonality. There are one-off events like COVID. There are changes to the maturity of certain markets. There are overarching factors that can affect regions, and there's not much a president can do about it. That has nothing to do with Biden. It has nothing to do with Trump. when you want to make a political assessment, you have to sort of exclude the things that have nothing to do with the president. It's sort of like, oh, gas prices were up and then they're down, and here's who was president. Okay, but unless we have a reason to say, here is why the president's actions were relevant to pricing, it's sort of a non-factor. What Trump is doing is he's lowering the supply of labor with the mass deportations. And he is also lowering demand for labor with the tariffs, which as companies lose profitability, they demand less labor. This isn't good for the economy overall. Those are not settings that will lead to a growing economy. And that's where we find ourselves, and it's not pointing in a good direction. Thanks for watching. Check out this other video. And if you like our content, make sure to subscribe so YouTube puts our videos in your feed, and subscribe to the podcast on Spotify and Apple.